Hey guys, David Robinson here. Welcome to the Lead Sponsor Podcast. Today we have Alix Kogan with us of Ashland Capital. Alex is a longtime real estate entrepreneur. He got started in the business about 24 years ago as a custom home builder and built a very successful custom home building and design business in Colorado. And after 20 years of building that up, as well as investing on the side, he would generate income through his building business, and then he would invest in a variety of different real estate opportunities with the income that he was generating from that business. And then after 20 years of being in that custom home building business, he actually exited and had a substantial capital event, which spurred him into larger commercial real estate investing. And so he focuses, has a pretty broad footprint of real estate investing as far as geographic footprint is concerned. He invests in the South, the Midwest, the Southeast, and the East. Hasn't gotten too much into the Mountain West yet, but has some interest there as well. Built up a he's built up a $250 million portfolio and acquired 7 deals just last year. And so he's got a great business. He talks about how his business is structured. He talks about how he's sourcing off-market opportunities, true, legitimate off-market opportunities. And we talk about what his expectations are moving forward in the new economy that we're in. And so I really enjoyed the conversation I had with Alex today, and I hope you do as well. Without further ado, Mr. Alix Kogan. All right, Alix Kogan, welcome to the show. I appreciate you coming on.
Yeah, glad to be here, David.
So, you've been in the real estate world for quite a long time, over 20 years, roughly. You have a vast amount of experience both in the construction world and also now in the commercial multifamily, student housing, commercial real estate investing space. Let's back up. Let's talk about how you got started in the real estate space back 20 years ago, and let's talk about sort of that growth period for you as you built your business, and let's go from there.
Sure. Yeah, I think my story is probably different than you hear with most syndicators. Mine is, covers now from '98 till today, so 24-ish years. So it was very, very gradual, very conservative, and really, started in '98 and got me where I am today. So started out in a real estate construction development family. My dad was a builder developer. My brother still is here in Chicago. I was the black sheep and actually did not want to go into the business. I actually ended up becoming a high school teacher for about a whole year and a half. So a bit of a detour from real estate and the family business, so to speak. Did that for a year and a half, and that's when I actually, was discontent with teaching. I loved parts of it, hated other parts, and decided to go back into construction and development. Moved to Colorado, which was near where I was teaching at the time, and started my company. So a little bit of a detour, but ultimately made my way back. And so '98, end of '98, beginning of '99, started my company in Durango, Colorado, Southwest Colorado. We built super high-end homes. It was a design build firm, so all vertically integrated, architects, designers, construction, all under one roof. Started small. Obviously, it was myself and another guy, and we just, a little bit of luck, a little bit of timing, all of it, and the business just doubled in size every year, and for many many years. And we ended up at the tail end of that 20 years being the largest single family high end custom builder in the Southwest Colorado region. But along the way, backing up, right away when I started my company, my vision was to buy real estate as well and develop real estate. So we started building high end homes. we started developing small multifamily, 10 unit, 20 unit, single family spec homes. We did subdivisions. So there was a whole host of development. So really it became kind of two verticals. It was the construction company, high-end design build construction company was the engine of all the revenue and profits. And then we took those profits and put them into development work and started really building both verticals at the same time. But again, it was slow, it was methodical. It wasn't, let's go out and build 200 units like a lot of guys are today. So I give them credit that there's guys who leave an IT job and somehow syndicate and get, 8, 9 partners. And before you know it, they're doing these massive projects. I didn't, I was never comfortable with that. I wanted to do something that I could do with my money and not take any investor money in. I wanted to, I just never felt comfortable doing that for 20 years or 17, 18 years, whatever it was. So anyways, grew that company. And then almost a third vertical, which was my own personal portfolio of buying existing assets. And not only were we developing, but I was buying rentals. And back then, they were called college rentals. It wasn't student housing. It wasn't really an institutionalized asset class. So I'd buy houses, duplexes, triplexes, rent them to college students, self-managed, and that was it really. So over 20 years, we grew and grew and grew, and one day I realized that I had this massive portfolio of scattered site, smaller assets that I either developed or bought, and that we were self-managing. And at that point, I realized through, some other opportunities that I could own in other states. I didn't have to self-manage. I didn't have to just own in my backyard. And that was really the trigger. There's a number of reasons, but that was one of them that caused me to pivot, sell that entire portfolio. My family and I, for other reasons, I had a kid later in life. So in 2015, we had our son, decided to move back to Chicago and raise our son in Chicago. So I sold the company in 2019, moved back in 2017 before I even sold it. But that 2-year period was really a transition of starting to buy larger assets all over the country, 100 plus conventional multifamily, as well as purpose-built student housing. So really the last 5 years bringing us today has been growing that portfolio and getting to where we are today. But sorry, that was a long way.
Nah, that's great. Great summary of 24 years of your life. So, okay, cool. Thanks for giving us that summary of, again, the last 24 years of your life. It seems like you can talk about it like that, but obviously there's a lot of learning experiences along the way. I want to dive into a few pieces of this. First off, the custom home build world back then, I mean, you dove into high-end luxury construction right out the gate. What gave you the confidence? I mean, I know that your dad was a builder and that you had been exposed to that world, but what gave you the confidence to go directly to that type of product right out the gate? I know I'm taking you way back, but I'm just curious.
Oh, that's a great question. So I grew up around it. I worked for my dad a little bit here and there, but as a young kid, just on job sites, cleaning up, but I loved the business, and I was a sponge, and I just sit around with my dad and talk to him about it. So I knew it, but I didn't know it. So what I did was I went to work for another builder for a year, and really saw what he was doing and realized that I thought I was young, dumb, and cocky. So I thought I could do it, and I thought I could do it better. And honestly, one of the greatest things that I think my parents did for me is just build a lot of confidence. And my dad was a kind of a guy that just never took no for an answer, and did other entrepreneurial things, and that's just the environment I grew up in. So I was fortunate that that's really all I knew was entrepreneurialism. Jump in, figure it out, get it done. And with that sort of blind, dumb confidence, I suppose, I dove right in. I mean, I ended up getting a client. I won't go into all the details of the story, but while I was working for this other firm, a potential client and the owner of that firm didn't see eye to eye. That that client called me on the side and said, "Hey, do you want to build my house?" So I took that opportunity,
And
and
that set you off to the races.
yeah, I gave my boss a 6 month notice that I was leaving, and then he got upset and let me go like 2 3 weeks later.
Oh wow. Yeah. Yeah,
Anyway,
I could see that coming.
yeah, so I went off and I built that house, and it was $1 million house in 99 2000, and got published in a magazine.
Mm.
So it's just like the perfect opportunity, the perfect result. Dumb luck. I got published in a national magazine for the house. And then during that project, I lined up 3 4 more homes, and the same kind of thing just kept going. I think that really the secret sauce was we were design build. I always had a strong passion for designing. Hired some designers that worked for me, and that differentiated us and really fueled our business, that we were different than anybody else in the market.
So what was it like, running a very successful high-end custom home build business while also trying to build up your own portfolio of investment properties? What were the challenges and what advice would you give to someone who's in a similar boat? Maybe their business isn't high-end construction, maybe it's just any other business that's high demand on your time and energy and focus while also trying to build up your own personal portfolio.
Well, I will say it's not easy, and I think when it started out, it was small. Buy a handful of homes a year, buy a 20 unit, a 30 unit, whatever it was. At that scale, it's manageable because I had a great team and I had the resources internally of my construction team with staff and a CFO that handled that portfolio for me. So at that point, it was easy. But I will say that one of my pain points is, as that portfolio grew, it took resources away from the primary company, and I saw that.
Mm.
And that's when ultimately I said, look, this has to be a standalone effort, business, and focus of mine. So it's not easy. I think it like anything, it's all about people. If you have great people, you could scale, you could do both. But what I wanted to do in owning larger assets and owning them around the country, really needed my focus to drive that business, and that's why I pivoted. And frankly, at that point, the custom home building and development business was running very well, and I had a great team after
Mm.
20 years. I could have kept that going, but I saw an opportunity to sell and take chips off the table, and then use all that capital to infuse into buying my own assets.
So I've got a follow-up question to that. If your life is a blueprint for an up and coming successful real estate investor, what's the better path? Is it to get involved in the business of real estate investing, or is it better to go build a business that's valuable that could potentially produce an exit and then get into real estate investing?
That's a great question. Um, I think both paths are legitimate, and I think it really comes down to the individual. If you have a skill set, if you have an opportunity to build a business, I love businesses. That they're great. However, um, for me, that's all ordinary income. So when I look back, and I won't tell you that I'm smart enough to have seen everything and strategized and set the blueprint and executed. Some of it happens by accident. You all of a sudden you have all this income, and you're paying a huge amount of taxes, and you're like, gee, what can I do? And then all of a sudden you say, depreciation, and maybe I'll buy this and offset that, and it evolves. But knowing what I know now, looking back, um, I don't think there's necessarily one answer. I think the key is, don't get too distracted by real estate if your business really needs your attention. So maybe, if you have the means, and maybe you're leaving corporate America, I think real estate is phenomenal, and I think you can get started in it. My suggestion to anybody is start small. Don't I think a lot of guys in today's world, unfortunately, we live in a world where information and access is so available, and everybody sees it and they think they can do it. And I think they get over their skis. And what's happened is the cheap money and the market that we just came out of is fueling all that, has fueled all that. And I think there's going to be a wake up call to a lot of the younger, newer syndicators out there that really don't have the business principles, don't have what you said, the business of real estate really, you know, perfected, or not even perfected, but they haven't put enough attention into the fundamentals of finance and in owning and acquiring real estate.
Yeah, love it. Well, yeah, I appreciate you going into that a little bit. I was just curious. I have some friends that have focused on business building versus investing. They go and have a big exit, and then all of a sudden they're headlong into real estate investing. So it's interesting to get your perspective about the better approach. It sounds like there's really no one right answer. It really depends on the individual's passion and skill set. I want to shift the conversation a little bit to talk about what your business looks like today. Obviously, you built up the custom home building business. You built up your own portfolio of investment properties, scattered site portfolio of a lot of different product type. And you exited that construction business, and now you're really heavily focused since 2019 on larger commercial, multifamily, and student housing. But maybe instead of me giving you the summary of your business, why don't you tell us, what do you focus on today? What does your business look like, and how is it structured?
Yeah, so in 2017, I sold the small portfolio, or the small scattered site asset portfolio. It was a larger portfolio, but of smaller assets. So since 2017, we started buying 100 plus communities around the country, as well as purpose-built student housing. We are in about 11, 12 states now. We just exited one in South Carolina. And then the student housing, it's typically we're buying 100 plus beds. Student housing is per the bed. So, 100 beds might be, whatever it is, 40, 50 doors spread amongst 100 beds. So that's really what we do. We focus on off-market opportunities. I'm sure you hear that a lot, but we truly have a team of guys that hits the phones and find, direct the seller. There's some other ways that we find deals with gatekeepers, so to speak, brokers, et cetera. So we've been fortunate. Last year we bought 7 deals, and almost all of them were off market. So we're excited that we're finding good value with that strategy. So we're a more or less a typical private equity shop, lead sponsor. We're finding the deals. We're raising capital from our circle of high net worth friends and family that invest in our deals, and that's what we do.
Love it. Yeah. So I'm curious. You have a pretty broad ranging geographic footprint, right? I mean, you haven't really gotten to the Western United States, but the South, Midwest, the Southeast. So you have a pretty broad geographical footprint. Talk to us a little bit about the sourcing of opportunities with that broad of a footprint.
Well, because we focus on off market, that's really part of what's driving that. You can say I want to buy in Greenville, South Carolina, which is one of our markets, or South Carolina in general. But there's only going to be so many off-market deals you're going to find. So what we do is we identify in general the number of different markets that we like, and then we kind of go through and spend a month focusing on North Carolina, South Carolina, the Midwest. And wherever those opportunities pop up, if they fit our buy box, it's a great opportunity and it's in a market that we like, we're going to buy. So that's why we've kind of spread out amongst a larger geographic area. We're not vertically integrated. We're not the property manager, but we partner with best-in-class property managers, and we have a full asset management team in-house. We have a head of construction. So we're very hands-on. I would say, in essence, the property management groups that we partner with handle most of the back office administrative. But in terms of the day-to-day, our asset managers and us, we're on the phone with our on-site property management maintenance staff. We're traveling to the properties a couple times a month. We're really driving the day-to-day, even though there's a third-party property manager. So we're able to scale. We're able to really control and manage our assets, and it's worked for us. We've, we target, the typical mid to high teen IRRs that every syndicator is looking for. I think that's compressing in these days, but fortunately, we've been able to significantly exceed that in our and everything that's gone full cycle for us. So something's working, and we're gonna keep doing it.
And it's interesting. I think it feels like operators go one direction or another, where they really go deep in one local market, but maybe their buy box in that market is a little bit broader, or they go wider, but they have a narrow buy box. Narrow meaning, or excuse me, wider meaning geographically, but they have a little bit tighter buy box as far as what they're looking for. I'm curious with the off-market strategy. Everybody talks about off-market deals, and you know they absolutely happen. Give us a typical deal that you would be looking for that's legitimately coming off market. Like how is that happening? Because what I hear is off market is really coming from a broker that's marketing it to a broad set of buyers. And then when it comes through my email, it says it's an off market deal, but it's been pitched to all the buyers that are available in the market.
Yeah.
So help us to understand sort of your philosophy around that and strategy around that.
Yeah, that's a great question. And what you just described, I don't consider off market. So I'll just give you just kind of a sampling of the off market deals that we did. I would say half of the off market deals that we bought last year were completely off market. We cold called the seller. The seller most often says, I'm not interested. We check back once a month. We continue to talk to them. A lot of them will say, well, I'm not ready to sell because I've got a huge prepayment penalty. Check back with me next year. So it triggers some conversations that we have with them to understand what their pain points. Why would they be interested in selling? Why wouldn't they be? Can we do an assumption? Really understand what their pain points are and what their motivations might or might not be. And so at least half of the deals that we did last year were acquired that way. They never hit the market. They were truly direct to seller. I mean, a testament to that, I think we bought something in Indianapolis for 70 a door. We were getting offers of 110 a door, a year later. And we just bought it right. We bought a deal in Ohio for 30 a door. Literally while we were under contract, somebody approached us through a property management group. They heard that we were under contract. They said, boy, I would have loved to have bought that deal. They offered us, I think 50. We could have doubled our money before even closing.
Wow.
So you can, and that's not the norm. You can uncover that kind of value, but it's not the norm. What our focus is on is we want to buy and buy at a good value. We're not trying to steal something, although occasionally you can, but we just want to avoid this process of things just getting bid up and paying above market. Some of the other opportunities, we just closed on a deal in Fayetteville, Arkansas, University of Arkansas. Great 2017 build, beautiful asset. I have a good friend who's a broker, who's a neighbor of mine. He lives literally 3 blocks away. He calls me up and said, look, I'm going to bring this to market. I'm going to show it to you first. Here's the strike price that the seller wants. If you want it, it's yours. It's yours to lose, so to speak. He said, I'm going to introduce you to the seller. You guys can negotiate direct. And that's what we did. Never hit the market. We were the only ones that looked at it. We were within $500,000 of the strike price. And he was comfortable. We bought that at a 6.25 cap a year ago, roughly now, and or maybe a little less than a year ago. And our debt's at 4.5 fixed for 5 years. So That's
Yeah.
a great
So,
opportunity.
would you say long term that the juice is worth the squeeze on sourcing your own opportunities? Clearly, you're basically taking the role of the broker at that point, right? Because the broker typically are the ones that are out there making the cold calls, doing the direct mail, doing the outreach to these owners, building relationships over time, following up, and then they're taking a cut of the deal and to bring it to a guy like you. But you're circumventing that. You're doing the direct to owner outreach. Long term, do you feel like that strategy is viable for you? And is the juice worth the squeeze for the amount of effort and energy that has to go into it to be able to get maybe an opportunity at a discounted price?
Well, I don't think it could be your sole strategy, and it's not ours. So we still nurture really good relationships with brokers. We have other avenues that, with property management groups, debt brokers who see deals fall apart, property management groups that see deals fall apart that they're doing inspections on, or assets in their own current portfolio that where they know us, they know that if they tip us off on a potential opportunity, that they'll be able to keep that asset in their portfolio because we will hire them. So there's just a number of different avenues. So it's not one. If it was just one, I agree with you. Would it be worth the squeeze? Just depends on how much you want to scale.
Mm.
Um, you're not going to find 10 deals off market, with one guy on the phone. So it's a lot of work, but in our instance, at least, the basis that we bought at is absolutely worth the squeeze because we have so much more upside that we've already built in.
Well, and I think there's a lot of people that over at least over the last 12 months wish they would have had a greater margin of safety in their basis as we head into some pretty uncharted waters at this point.
Yeah.
Let's move the conversation in that direction real quick in the time that we have left. What are your thoughts on what's going on in the market? What are the challenges that you guys are experiencing, and how do you see yourself navigating the waters ahead?
So the obvious challenge is the debt markets. The debt markets are crazy and they're unpredictable. We know today that interest rates are going to go up. For how long and how high, nobody knows. So it's difficult to predict your exit cap, right? Having said that, I'm pretty comfortable that they're never going to go back to the cap rates that we've experienced for the last X amount of years. I just don't think your debt will go down that low. It was basically free money. So you just have to be very, very smart in how you underwrite, and also for us is have long-term debt available and have fixed rate debt available. The days of floating rate debt and bridge loans, while there are some opportunities with a clear path to stabilizing that I think fits that bucket, we're not looking at those kind of opportunities. We're really trying to be conservative and walk into cash flow. If we can walk into cash flow and there's still some upside, we can still grow rents. Of course, rents could be under market, but every assumption is just much more conservative today than it has been in the past. I can't just expect an average $50,000 earner to be able to handle a $200-300 rent increase and keep them as a renter. I have to assume that I'm going to turn that demographic to be able to support that $200-300 rent bump. And if that's the case, at least my model supports it. I've got a higher economic vacancy to do that. But in general, the heavier lifts, all those types of repositions, we're being much more conservative on today. So the debt is really the challenge. And then the second challenge is the bid-ask spread between buyers and sellers. Sellers are their mindset still 6 months ago. But that's changing quickly.
It
And
is.
I think there's going to be a lot of opportunities as people are ready to take their medicine and they have to sell.
Yeah. And just for reference for all of you that are listening, we're recording just the end of October here, just for some perspective. Yeah, it's interesting what's happening in the market. I wonder, does your strategy as far as sourcing deals change at all? Do you lean into off market in times like this? Do you lean into broker relationships? I know that you have a variety of different sourcing strategies. I'm just curious if your strategy for sourcing deals changes in this type of environment.
Well, I think we're going to be focused on the owners and deals that we know have floating rate debt that could be running out of their IO period. Um, they're going to be squeezed. So, there's data out there that can tell us where those deals are. And, we're not going to prey on people, but if they have to sell, we want to be the first person that they think about. So, does it necessarily change? No, it doesn't change from off market broker relationships. All the other channels and gatekeepers of deals are still there. But we may be looking at different motivations, obviously.
Yeah.
What's the pain point that's going to cause them to sell? And then I think the other thing is figuring out whether somebody's a market seller. There's a lot of sellers out there just sort of putting a deal out there in this environment to see if they can get yesterday's pricing today. And that's not a market seller, because if they can't get their price today, they're wasting a lot of time. They're wasting their own time. They're wasting buyers' time, brokers' time. And we have seen that in the last few months. We've seen a couple of deals just not trade, which is unfortunate. You have to decide, are you a market seller or not?
Yeah. Yeah. Great insight. Last question I've got for you about your business is typically I see sponsors and syndicators either lean heavily and specialize in multifamily, student housing, or they go more of the traditional multifamily route. You've sort of crossed over in those different asset types and specialties. Give me your thoughts on why that is, and do you have a preference? Do you have like, hey, you know what? If I have to buy something today, all things being equal, I'm going student housing or I'm going conventional multifamily.
I don't have a preference. I actually like the diversity of having both asset classes. Initially, student housing was intimidating, but it was interesting because of my background of college rentals, of these one-offs, and knowing, understanding that demographic. So that's what really captured my interest. And then I developed some relationships with best-in-class property management groups, developed a friendship. The particular individual I'm talking about is here in Chicago. So it gave me comfort that I had the support and in the intel at an institutional level to run student housing. And it's proven very successful for us. But it is a whole different business.
Mm-hmm.
You can either excel or you can get hurt. But I also like it because it's a higher barrier to entry. Conventional guys typically don't, sort of move over into that space. And some can do it and some can't. We bought a deal from University of Florida this year from a group that tried to do that and did it unsuccessfully. We bought that deal from them. We're like 97% occupied, ahead of performa, and just firing in all cylinders because we have the right property management group partner. So
Yeah.
I like them both.
Love it. Great answer. I wish I could pin you down on one or the other, but I can understand the intrigue in both sides. Well, look, Alex, this has been a great conversation. I've enjoyed hearing about your background and your story about getting into the space and ultimately how your business is structured and what you're focused on. Some of the unique things that you do to source some off market deals and how you really lean into that. Before I let you go, what's the best way for our listeners to connect with you, learn more about your business and what you have going on?
Sure. Well, the website is ashlandcapitalfund.com. My email is Alix, Alix, it's with an I, at ashlandcapitalfund.com.
Awesome. We'll have that in the show notes. So if you're listening right now and you enjoyed the conversation that we had with Alex today, go down into the show notes and click on that link to head over to his website as well as his email. Alex, again, an honor to have you on the show. Thank you for coming on and sharing your journey with us and your insights. And I look forward to staying in touch down the road.
Thanks, David. Good to be here today.